So we have to take another look at Senseonics Holdings, whose stock is just going insane right now, being up more than 100% again after pulling back from initial spikes at the beginning of the year. As we peaked however at right above $4 and are currently selling off again, what we are going to do today is give you an updated insight into what is happening to Senseonics stock and break down exactly whether it is still a buy at the end. And as the analysis in the video is absolutely crucial to consider before buying the stock, make sure to stay tuned. But before we jump right in, just hit that subscribe button down below. And as we'll keep you updated on breaking news and awesome trading opportunities every single day, subscribing would not only help us but also you. So there is really no excuse for not smashing the subscribe button, it's free, and you can always unsubscribe if you feel so. Alright, let's start talking about the stock. So Senseonics basically is a medical technology company focused on providing implantable glucose monitoring systems or CGMs for those with diabetes. The company made some incredible progress on its commercialization of these devices and appears ready to target a multi-billion-dollar opportunity in the diabetes space. In particular, its Senseonics Eversense XL product is what most investors have their eye on right now. But, and this is crucial to consider for our prediction at the end of this video, these devices haven't only received a lot of attention from investors. Essentia, another huge player in the area for example, has recently backed Senseonics. In addition to raising capital via convertible debt with this Essentia partnership, the two companies have set themselves the mission to bring Senseonics core products to market. As said before, this high-profile backer has provided significant validation to investors on the fence with the stock. Additionally, investors can start to see a path forward to long-term growth and eventual profitability if this collaboration yields fruit. And there are a few very important reasons to know before buying the stock that could prove this assumption. So as an early-stage medical device company, Senseonics currently doesn't have a lot of revenue to show for its efforts. Over the past 12 months the company's brought in less than $5 million in revenue. However, this stock has garnered sufficient excitement to justify a $850 million market capitalization. Accordingly, something must be up for investors to be willing to put their money to work in the company at these levels. That's what we have to take a look at now. So in early February, Senseonics announced the initiation of European commercialization activities for its CGM system. In partnership with Essentia Diabetes Care, the company is looking to bring its products to market in Europe with the hope that they will be well observed there. Essentia has had tremendous success in marketing its Contour CGM products in Europe, and Senseonics is hopeful this partnership will yield fruit. As mentioned, the fact that the Eversense product is approved in the US and is beginning commercialization efforts in the US and Europe is important. These markets are two of the crown jewels in the global diabetes device market. But what is way more interesting, and the main reason for the stock to be up so much in the first place, is the massive hype it currently experiences from retail traders and videos like this one talking about the potential of the company. And it's got all the makings of a successful meme stock breakout. It is a single-digit stock with a small float of just 280 million shares, high short interest with 25% of that float sold short, and tons of retail attention. That's the same recipe which caused GameStop, AMC, Clover, and others to break out as well. Nevertheless, this stock is certainly not cheap right now, and investors are taking a leap of faith of sorts with Senseonics at this level. Execution risk remains high with the stock, and the company will need to continue to show results from its commercialization efforts before we see this stock take off. So there is certainly huge potential growth here in the company, but it's nevertheless a risky pick considering the current valuation. If you liked this video and want to support our mission of providing free financial information to everyone here on YouTube, please ensure you're subscribed and definitely consider leaving a like. As mentioned before, it really means the world to us. Thanks a lot, and see you next time.